The Three-Part Money Series. Video 2 of 3. Conservative versus Risky Investing in the U.S. Market. You did the hard work. You found the hidden money in your budget. Now, the real game begins. Making your cash multiply. Do you choose safety or do you go for growth? We are diving into the American investment landscape, breaking down the best conservative options to protect your capital and the high-risk moves to accelerate your wealth. This is where you turn savings into more money. More money. Welcome back to the second part of our essential three-part Money Mastery series. In the first video, we showed you how to strategically cut costs and reclaim thousands of dollars that were leaking out of your budget. If you missed it, go back and watch it first, because without that saved cash, this step is impossible. Today, we are focusing on the central pillar of wealth creation: investing. Specifically, how to balance the need for safety with the desire for rapid growth in the current short to medium term U.S. economy. You must build a financial fortress before you launch financial rockets. That means dividing your capital into two distinct buckets: conservative investments and high-risk investments. Bucket 1. Conservative investments. Capital protection. The goal here is simple: beat inflation and keep your principal absolutely safe. These are the funds you need access to in the short term, like your emergency fund or money earmarked for a down payment. In the current U.S. economy, with the Federal Reserve managing interest rates, these are your best low-risk options. Example 1. U.S. Treasury bills, T-bills, and bonds. These are considered the safest investments in the world, backed by the full faith and credit of the U.S. government. In a high-interest rate environment, T-bills offer attractive short-term yields, often outperforming savings accounts and certificates of deposit, or CDs. They mature in a few months to a year, making them perfect for cash you need to protect and grow slightly without taking on any stock market risk. Example 2. High-yield savings accounts, HYSE, and money market funds. These are accessible through banks or brokerage firms and offer significantly higher interest rates than traditional checking or savings accounts. Money market funds, in particular, invest in very short-term, high-quality debt and provide excellent liquidity, meaning you can pull your money out immediately. These are the modern alternative to a basic savings account and are essential for your emergency cash. Example 3. Ultra short-term bond ETFs. For a slightly better return than a savings account, but still very low risk, these exchange-traded funds invest in bonds that mature within 1 or 2 years. They provide diversification and are less sensitive to interest rate changes than longer-term bonds, making them ideal for the medium-term portion of your safety bucket. Bucket 2. High-risk investments, capital growth. This bucket is for the capital you do not need for at least 5 years. The goal is maximum growth, which means accepting higher volatility and the risk of loss. In the U.S. market, 3 areas currently define the high-risk, high-reward potential. Example 1. Disruptive technology sectors, AI and cloud. Look beyond the mega-cap tech stocks and target companies focused on specific disruptive technologies like generative AI infrastructure, specialized cloud computing services, or cybersecurity. The massive ongoing investment cycle, driven by giants like Accenture, as discussed in our last video, means these niche companies have exponential growth potential, but their stock prices are extremely volatile. They offer the potential for high returns but require a strong stomach for market swings. Example 2. Small cap and mid-cap value stocks. While everyone focuses on the S&P 500, significant alpha or outperformance often comes from smaller companies. Small cap and mid-cap stocks are generally more sensitive to the domestic U.S. economy. If you believe the U.S. economy will continue to grow in the short to medium term, These stocks or dedicated small-cap ETFs can provide growth that exceeds the large established companies. The risk is that they are the first to fall during a market recession. Example: 3. Sector-specific investments, healthcare and renewables. Targeting specific ETFs or individual stocks in rapidly expanding sectors can be a high-reward strategy. For example, the U.S. aging population creates a strong secular tailwind for certain healthcare technology and pharmaceutical companies. Similarly, government incentives and corporate commitments drive immense investment into renewable energy infrastructure. Focusing on these high-conviction sectors is a riskier, concentrated bet than broad market index funds. The golden rule of balance. Your age minus 100 is often used as a rough guide for the percentage of your portfolio that should be invested in high-risk assets like stocks. For example, a 40-year-old may keep 60% in stocks and 40% in conservative assets. However, your true risk tolerance is personal. The key is to start with a rock-solid foundation of conservative assets, enough to cover your emergency fund and all short-term goals before you ever allocate a single dollar to the high-risk bucket. Never gamble with the money you need. What is your preferred strategy? Safety or high-risk growth? Share your investment strategy with me in the comments below. If you are excited to learn how to make money while you sleep, leave a like and subscribe to the channel so you do not miss the final part of our Money Mastery series. The goal is always to get you more money. See you next time.